Welcome to Beyond the Comfort Zone, talking shit with King-KAMBUF. We are kicking off the year. It is January 1st, 2026, with a really specialized deep dive.
Yep.
We're calling this one the Reserve of KAMBUF Financial News and Reports Magazine Weekly Market Digest and Investment Analysis. And the focus today is something called the TKIF MA Ribbon Playbook.
That's right. And this isn't, your typical market commentary. What we have here is, well, it's more like a blueprint, a tactical trading system.
It really is. The source material feels like an internal institutional document. It's focused entirely on a very formal style of moving average analysis. The whole point seems to be putting the user, you, directly in sync with how a trend actually develops.
Exactly. I think for anyone who's felt lost in all the noise, the day-to-day chatter, this is a complete structural system. The document's whole purpose is to create this multi-period moving average ribbon strategy.
The TKIF Playbook.
The TKIF Playbook. And we should probably clarify that acronym right away because it's important. TKIF stands for Trend Kinetic Intermediate Filter Engine.
Okay, so it's an engine?
It's an engine. It's designed to tell you the market's kinetics, its momentum, but filtered through these key intermediate structural averages. The goal is complete comprehension. You want to be able to look at a chart and instantly read the health and the direction of a trend.
And not just the direction, but also spot when it's what? Topping out or bottoming.
Precisely. Spotting that topping or bottoming behavior is critical. And maybe most importantly, you're trying to figure out where today's price, which the source calls the one-day moving average, is likely to go next, all based on its relationship to this really complex structure.
And when you say complex structure, you really mean it. I was looking at this, and we are not just talking about the standard 20-day or 50-day moving averages here.
They're not even close.
This playbook uses, 10 specific simple moving averages? SMAs. Let's just lay this blueprint out right at the start, because the choice of these numbers feels like the system's DNA.
It absolutely is.
Okay, so the MAs are the 5, 10, and 20.
Your fast ones.
Right. Then the 50, 90, 120.
The intermediate structure.
And then it gets really deep. The 200, 270, 350, and 500. A 500-day moving average. That's looking back at nearly 2 full years of trading action.
It's a very unusual spread. I mean, unusually wide and deep.
Yeah.
And you're right, the selection of each one of those numbers is highly intentional. The core idea here is that market movement is fractal.
Meaning you can't just look at one time frame.
You can't. You'll get burned.
Yeah.
You have to understand the immediate timing, the intermediate support, and the ultimate long-term gravity all at once. So these 10 MAs, they're chosen specifically to define all those different gears of market movement at the same time.
It prevents you from, say, buying a short-term dip right into the face of long-term downward pressure.
Exactly. It stops you from trading short-term noise against that long-term gravity.
I really like that focus on simultaneous analysis. Okay. Let's unpack this blueprint. We'll follow the structure from the source material itself. First, we're going to map out how to actually read this ribbon visually, the market gears, what each set of averages means. Second, we'll define the market regimes. This seems critical. It tells us which way we should be trading, and maybe more importantly, when we should not be trading at all.
The stay-out signal, yeah.
And finally, we'll dive into the mechanical stuff, the actual entry and exit rules that make this an actionable system. So if you're serious about understanding how institutional money looks at price structure, I think this deep dive is your shortcut.
Yeah, I think so too.
Right.
So when you first put these 10 lines on a chart, let's be honest, it looks like a mess, a spaghetti monster.
Right.
But the genius of the TKIF playbook is that it immediately organizes them. It groups them into 3 functional categories, or what the source calls the 3 market gears. This is the first step. It simplifies the complexity.
Okay, let's start with the fastest one then. Gear A. This is the 5, the 10, and the 20-day SMAs. What's their specific job in this system?
Their job is price pressure and timing. That's it. Think of it as the market's immediate reaction layer. They respond almost instantly to any short-term buying or selling.
So if price is consistently above the 5 and 10,
you have immediate upward pressure. Simple as that. If that 5-day starts to cross below the 10, that's your micro-timing signal. It's a tiny hesitation, a slight reversal in momentum. For a trade to be really healthy, the price should almost surf on top of the 5 and 10.
And the 20?
The 20 is for, very shallow, very fast pullbacks. Think of the 5 and 10 as your throttle, and the 20 is maybe your emergency short-term break.
Okay, that makes sense. So that's the velocity. Let's move to Gear B, the medium term. The 50, 90, and 120 SMAs. You said earlier these are the structural core. Why these specific numbers?
Because they define the whole intermediate swing structure. The 50-day SMA, that's roughly 2 calendar months of trading, is the standard for intermediate momentum. In a healthy uptrend, the playbook designates the 50 as the primary dynamic support. It's where a healthy pullback should find buyers.
And the 90, that's one you don't hear about as often.
Right, it's often overlooked, but the playbook uses it to reinforce that zone. It's 3 months of data, a full quarter. So if price breaks through the 50, the 90 is your next line of defense.
And then the 120.
That.
4 months. The source calls this one the non-negotiable line in the sand.
That's exactly what it is. If you're in an established uptrend and price closes decisively below the 120, the intermediate structure is considered broken. You have to assume a much bigger correction or even a full regime change is starting. Gear B basically defines where a correction should stop before you have to invalidate your whole bullish thesis.
So if Gear A is the throttle, Gear B is like the suspension system.
Yeah.
It defines how rough the ride can get before the whole thing breaks down.
That's a great way to put it.
Which leaves Gear C, the long group, 200, 270, 350, and 500. This is where that institutional focus really comes through. I mean, those are huge numbers. What's the explicit reason for including something like a 350 or 500-day average?
This is the primary trend and regime gravity layer. The 200-day is the benchmark, right? It's about 1 trading year. But why go deeper? Because institutional portfolio managers, they're not thinking quarter to quarter. They're managing assets across multi-year cycles. So 270 days is about 1.25 years. The 350 is roughly 1.5 years. And the 500-day captures almost 2 full calendar years of data. These lines, they change slope extremely slowly.
Which makes them reliable.
Very reliable stabilizers. They define that long-term gravity. They are the ultimate lines that big money respects because they reflect market memory across full budget cycles, across economic phases. If you see price interacting with the 500-day average, you are dealing with multi-year psychology. They're not just support levels, they are the boundaries that define the entire market environment.
That commitment to multi-year history, it really explains the strategic depth here. Okay, so we have the gears. Now, the playbook details 4 key variables that dictate the quality of the trend, and they're listed in order of importance. The first one is order, or stacking.
This is fundamental. It's just the sequence of the lines. In a perfect, healthy bull trend, the lines should stack cleanly from smallest to largest. 5 above 10, 10 above 20, all the way down to the 500.
Perfect order.
Perfect. Orderly stacking. It tells you that every single time frame, from 5 days to 2 years, is confirming the exact same direction. It's market consensus. Any disruption in that order, say the 50 crosses below the 90, that's an immediate structural warning sign, even if the price is making a new high that day.
And the reverse is true for a bear trend, just flipped upside down.
Exactly. 5 below 10, 10 below 20, and so on.
Okay, but order alone isn't enough. The second variable is slope. This seems crucial. Why distinguish slope from order? If they're stacked perfectly, doesn't that imply good momentum?
That is a fantastic question, and it's a critical distinction. Order defines the structure, but slope defines the velocity. Imagine you have perfect stacking, but all 10 lines are completely flat, just horizontal.
Okay, so the structure is bullish, but it's not going anywhere.
Exactly. You're not in a trend. You're in a consolidation phase, a lull, which might come before a huge breakout, but right now there's 0 velocity. But if the lines are stacked and they're all rising sharply, now that's accelerating momentum. That is a healthy trend that is actively pulling the market higher. Slope gives you the momentum context that stops you from buying into a stagnant market.
That's a great way to think about it. The third variable is fascinating to me. It's spacing, the difference between expanding and compressing spacing.
Spacing is the visual cue for the trend's health, its energy. Expanding spacing means the MAs are fanning out, getting further and further apart. The fast MAs are aggressively pulling away from the slow ones.
Like stepping on the gas.
Exactly. The ribbon fans open wide. It's the visual confirmation of a healthy, accelerating trend. Conversely, when the spacing starts compressing, when the whole ribbon squeezes tightly together, that is a massive signal of trend exhaustion. A reversal could be coming.
So compression signals transition or chop?
Right. Feel a bit like a rubber band. The energy is dissipating, the averages are all coming back to a neutral state, getting ready to either coil for another move or just snap back.
So compression is that final warning before the order might break down. And that leads to the last variable, price location, or, as the source says, where the one-day MA sits.
This is your immediate tactical risk check. Where's the price right now relative to the 20, the 50, and the 120? That defines your immediate trade decision. If the price is struggling to even hold above the 50, I don't care how bullish your 200 and 500 MAs look, you have immediate tactical weakness.
And if it's comfortably above the 120 and 50?
You have immediate tactical strength. The price is the fastest variable, and how it interacts with that ribbon dictates which play you need to run from the playbook. It's the real-time variable you're always trying to predict.
Okay, that structural map is essential, but the playbook is really explicit about this next part. It says the biggest mistake a trader can make is trading against the primary regime. So this whole strategy is built to keep you on the high probability side of the market by using those long-term MAs to define the bias first.
100%. The market's main directive, up or down, is set by the most resilient averages, Gear C. And so the playbook gives us two non-negotiable primary filters for defining a regime, and they are centered on that structural core, the 120 and the 200 SMAs.
Let's define the bull regime first. What is the absolute non-negotiable anchor for that?
It's a two-part anchor, and you need both. First, the 120-day SMA must be structurally above the 200-day SMA. That's your classic intermediate versus long-term confirmation. 4-month average is higher than the annual average. The trend is generally positive.
Okay, but there's a second part.
Yes, and this is the part people often forget. The secondary filter is the slope of the deepest structure. The 200-day SMA must be actively sloping up. Today's 200-day average has to be greater than yesterday's.
Now, hold on. Why is the slope of the 200 so critical? Couldn't the 120 just pop above a flat 200 after a quick rally?
It could, and that's exactly why the slope is the mandatory filter. If the 200-day average is flat, it means the market has just been going sideways for an entire year. A 120-200 cross on a flat 200 is often a fake out. It's unstable. Requiring the 200 to be actively rising ensures that the long-term gravity, that institutional memory, is actively pulling in your direction.
You need to know the deepest average is actually getting better, not just that the shorter ones caught up to it.
Precisely.
So once that primary filter is met, the supporting filters are just for confirmation of health.
That's right. They're what you'd expect. Medium trend confirmation, which is 50 above 120. Strong price location, price mostly holding above the 50 and 120. And of course, clean stacking, 5 over 10 over 20 and so on.
So when all that lines up, the rule is simple. Buy the pullbacks.
Buy pullbacks, and you avoid shorts unless you're doing it, a very quick tactical scalp that fully respects that overriding bull structure.
Okay, let's flip it. Defining the bear regime. This is where the discipline really kicks in.
The conditions are perfectly symmetrical. The primary filter, the 120-day SMA, must be below the 200-day SMA. And critically, the 200-day SMA must be actively sloping down.
The gravity has to be pulling the price lower.
Yes. And the supporting filters are the same, just inverted. The 50 is below the 120, price is mostly below the 50 and 120, and you have that clean bearish stacking, 5 under 10 under 20.
And in a confirmed bear regime, the rule is reversed. We short the rallies, and the source is very clear on this. We avoid trying to catch falling knives.
That one rule will save you a fortune. Trying to call the exact bottom in a confirmed bear regime defined by those huge MAs, it's just the definition of a low-probability, capital-destroying trade. The system is designed to keep you on the high-probability side. That means you wait for rallies to short into, using those MAs as resistance.
But as we know, the market isn't always in a clear bull or bear trend. A lot of time is spent in what the source calls the transition or chop regime, the danger zone. This is where a filter system like this really earns its keep.
It absolutely does. This is what kills most traders, because it just spits out constant false signals. Visually, the cues are pretty obvious. The averages braid together.
Intertwined.
Yeah, they're all tangled up, crossing back and forth. Specifically, the 20, 50, 90, and 120 will be flat, horizontal, and just weaving in and out of each other with no clear direction. And the price will just whip above and below the 20 and 50 over and over again.
Now, what's great about the source materials is it doesn't just leave this to your eyes. It gives a specific mechanical filter for this, the mechanical braid filter. It's a line of code, ABS, SMA 20, SMA 50 close, 0.0005. Can you break that down?
Yeah.
Because normalizing it by the close seems important.
Yeah, this is a perfect example of that institutional rigor we talked about. The formula is all about measuring trendlessness. So ABS, SMA 20, SMA 50, is just the raw dollar difference between those two key averages.
Right.
If they're far apart, you have a trend. If they're close, you have consolidation. But a $1 difference on a $10 stock is huge.
Right.
On a $1,000 stock, it's nothing.
So dividing by the current price normalizes it into a percentage.
Exactly. Dividing by close makes it relative. So 0.005 translates to the 20 and 50 MAs are less than 0.5% apart. If those two key structural averages are that close, volatility is too low, direction is absent. This normalization means the filter works just as well on a penny stock as it does on Amazon. It's the system's firewall.
And when they're braided like that, the rule is simple. Wait.
The highest virtue here is discipline. The moment that formula triggers, you step aside. The playbook prioritizes sitting out these regimes entirely for trend following. Trading job is just expensive. The best trade is often no trade.
Right. So with the regime defined, now we can get into execution. The playbook really centers on the core setup, which it calls trend continuation. This is the main money setup.
And it makes sense, right? It's the highest probability because you're trading with the confirmed gravity, with the regime.
Yeah.
But you can only even consider this setup after that non-negotiable bias check is passed. 120 versus 200 and the 200 slope confirmed.
Okay, let's stick with the long side for this example. A bull regime is confirmed. The pullback setup requires price to pull back into what it calls the high probability zone, which is defined as being between the SMA 20 and the SMA 50.
That zone is critical. It represents a healthy, normal correction. It's short-term weakness, right? The price drops below the fast MAs, but it's being absorbed by that medium-term structure, by gear B. This is where the patient structural money steps in.
So the price is in the zone. Then we need the trigger, the signal that buyers are coming back. The source says it's when the SMA 5 crosses above the SMA 10. Now, why use such a fast trigger? Isn't a 5-10 cross kind of prone to being just noise?
It is, and that's a fair challenge. This
No.
is where the confirmation piece is so important. The 5-10 cross is used specifically because it's fast. It gets you in early, which improves your risk reward. It signals that immediate momentum is shifting back to the buyers. But you cannot, under any circumstances, trade that cross by itself.
So you need the validation.
You need the structural validation. And the confirmation is this. Price must close back above the SMA 20 on the very same bar that the 5-10 cross happens.
Ah, okay, so the 5-10 cross gives you the speed, but reclaiming the 20 gives you the durability.
That's it, exactly. You need both. Reclaiming the 20-day confirms that the momentum shift is strong enough to overcome that first layer of resistance. And then your trade management is really clean. Your stop goes below the 50-day moving average or below the swing low of that pullback. Because if you lose the 50, gear B is compromised, and the whole reason for the trade is gone.
Makes sense. Let's move to entry type 2, breakout and retest. The playbook calls this one the institutional favorite. In a world that's obsessed with chasing momentum, why is waiting for the retest the safer institutional play?
Because institutional money prioritizes risk management over everything else. Chasing a breakout means you're buying at the point of maximum excitement, often right into overhead supply from people taking profits. It makes you super vulnerable to an immediate pullback or a stop hunt.
The classic throwback.
The classic throwback. The institutional approach forces the market to prove itself first.
So the setup is you see the price break a prior high, and the ribbon starts to fan out. The 20 and 50 are turning up. The trend is waking up.
Correct. But the trigger isn't the break. The trigger is waiting for the retest. You wait for the price to pull back to the level it just broke. What was resistance is now potential support, and you need to see it hold that line.
Ideally, that old resistance lines up with the 20 or 50 MA.
That's the A+ setup.
Right.
And then the bullish 5-10 recross confirms that the market respected that new support level and is ready to go for the second leg up. It completely avoids buying the exact top of that first surge and filters out so many failed breakouts.
Finally, we have to talk about entry type 3, bottoming reversal. The playbook is very clear here. This is the hardest entry. It's described as a process, not just a crossover.
Yeah, you're fighting gravity here until that big 200 MA starts to turn. This is a high-risk scenario. It should be traded with smaller size, if at all. The KING-KAMBUF playbook hammers this point home. You cannot rely on one crossover. You need a sequence of events, a whole bottoming checklist that proves the market is actually shifting its long-term view.
Okay, let's walk through that sequential checklist. This seems really important.
It is. First, price has to start closing above the 20-day SMA more often. The sign short-term buyers are starting to win some battles. Second, the fast MAs, the 5 and 10, they have to flatten out and turn up. They have to stop making lower lows. The immediate downward velocity is gone.
Okay.
Third, the SMA 20 itself has to flatten and start to curl up. That shows the shallow support structure is stabilizing. Fourth, and this is key, you must see the ribbon compress before it expands upward again.
The energy coiling up.
Right. And then the final strong confirmation is the structural flip. The 20 crosses above the 50, and then much later the 50 crosses above the 120. Until that 50 crosses the 120, you are still technically in a recovery, not a confirmed bull trend.
That distinction is vital. And since this is so risky, how does the playbook separate the early aggressive entry from the safer, more conservative one?
The aggressive entry is for experienced traders only. It happens when price reclaims the 20 MA. You get a bullish 5-10 cross, and you see a clear higher low form. You are basically front-running the 20-50 cross, but your chance of failure is much higher. Your stop has to be razor tight.
And the conservative entry.
The conservative entry is much safer, more reliable. You wait until after the 20 is officially crossed above the 50, and the 50 is either flat or rising. This entry ensures that the medium-term trend, gear B, is already starting to turn in your favor. It really reduces the risk of the reversal failing and just dropping back into that long-term bear regime.
Right, so profitability is really dictated by the exit. The playbook makes this great point that topping isn't the full trend reversal. It's just the momentum dying before the structure fully flips.
That is the difference between taking a profit and waiting until you're back at break-even or worse.
So what are the early topping warnings? The signals that scream, take some money off the table or tighten your stop right now. They're all from the fast MAs, from Gear A.
Right. The first one is a classic divergence. Price makes a new high, but the 5, 10, and 20 MAs are all flat. Momentum is not confirming the new price high. Huge red flag.
Okay.
Second, you see repeated failures for the price to hold above the 5 and 10 MAs. The immediate buying pressure is just gone. Third, the fast ribbon itself starts to invert. The 5 crosses below the 10, then the 10 crosses below the 20. The fastest gears are all flashing red.
And what about structurally?
The most important short-term structural warning is when price closes below the 20-day SMA and then fails to get back above it within, say, 1 to 3 trading sessions. Losing that shallow support and failing to get it back means the pullback is probably going to deepen toward the 50-day.
And then there's the compression warning again.
Yes. If the ribbon compresses after being really wide and fanned out, that's trend exhaustion. A pullback is coming, period, regardless of what the price is doing.
So those are the warnings. The actual confirmation signals that the intermediate trend is turning are bigger moves.
Much bigger. The medium confirmation, the real structural warning, is when the 20 crosses below the 50. If the 50 then flattens and rolls over, your intermediate swing trend gear B is officially compromised. For most swing traders, that is the exit signal.
And the biggest warning of all.
The bear confirmation. That's when the 50 crosses below the 120, and then eventually the 120 crosses below the 200. When that sequence happens, the entire regime is flipping. Your bias has to change from buying dips to shorting rallies.
Okay, let's talk practical exit rules. The playbook says you have to be consistent. You pick a style, and you stick with it. It's either the swing style or the fast style.
The swing style is designed to capture the majority of a trend and ignore the noise. The primary exit signal is a closing price below the 50-day moving average. Once you're in profit, you just trail your stop under that rising 50 MA. This lets you ride through healthy pullbacks that often stop right at the 50, but it gets you out the moment the core integrity of Gear B is broken.
It's the durable method.
It is. The fast style is for more active management or for more volatile stocks. Here, the exit is much tighter. It's a close below the 20-day SMA or when the 5 crosses below the 10 after a big extended move. You'll lock in gains quicker, but you have to accept you'll get whipsawed out of trades more often.
And beneath all of this are the hard stops. There's a mechanical logic for this based on the 50 MA.
This is non-negotiable risk management. The long stop is defined mechanically, SMA 50, one stop pack. So if your stop pack is, say, 1.5%, your hard stop is placed 1.5% below the 50-day MA.
And that's brilliant because it's dynamic.
It's completely dynamic. It adjusts to volatility and price. Your max loss is always relative to the current structural support, not some fixed dollar amount you picked out of thin air. As the 50 MA rises, your stop automatically rises with it. It's smart.
So beyond just entries and exits, the ribbon is also this dynamic map. The MAs change their function, their job based on the regime. This idea of polarity is everywhere.
It's everything. And the key is predictability. In a strong bull trend, the MAs are reliable support. The 20 is shallow support, the perfect bounce spot in a fast move. The 50 and 90 are your deep support where bigger money is waiting. And the 120 is that line in the sand.
And the second the regime flips to a bear trend, those exact same lines become overhead resistance or caps.
Instantly. They flip polarity. In a bear market, the highest probability short trade is when price rallies up to touch the 20 or the 50 or the 90. The trigger is seeing it fail there, confirmed by a bearish 5-10 cross back down. The 120 becomes this ultimate ceiling. You have to learn to see them as allies, not obstacles.
The source material also puts a huge emphasis on the power of confluence when multiple MAs cluster together in one spot.
Yeah, confluence zones are where market memory is just screaming at you. The playbook specifically highlights when the 50, the 90, and the 120 all bunch together.
Why that group specifically?
Because you have 3 different measures of intermediate structure. 2 months, 3 months, and 4 months of data, all pointing to the exact same price level. If price pulls back to that triple confluence zone in an uptrend, you have maximum structural backing. The playbook basically says this is an impenetrable support shelf. Your conviction on a trade there should be at maximum.
And we can't forget the foundation. You still have to layer in simple static horizontal levels. The ribbon is powerful, but it's not the whole story.
Never. You never rely on dynamic levels alone. The best trades happen at the intersection. You have to mark your prior swing highs and lows, your big gap levels, your high volume nodes. The highest conviction trades, the A-plus setups, happen when a static horizontal level like a previous breakout point lines up perfectly with a key dynamic MA, like the 50 or the 90.
Because it proves that both price memory and time-based memory are focused on the exact same point.
Exactly. It's the most durable zone you can find.
Okay, so to make this practical, the source provides a rigid rules card. This is the actionable TKIF playbook that you could actually code and backtest.
Yes, it boils it all down.
Let's review those core rules, starting with longs, the continuation entry.
For longs, it's only valid when the 120 is greater than the 200 and the 200 is rising. The entry sequence is a pullback into that 20 to 50 zone. You get the 5 crossing above the 10, and it's validated by a close back above the 20. Stop goes below the 50. Exit is a close below the 50. That's the whole package.
And the rule set for shorts.
Symmetrical. Shorts are only valid when the 120 is less than the 200 and the 200 is falling. Entry is on a rally up to the 20 to 50 zone, confirmed by the 5 crossing under the 10, and validated by a close back below the 20. Stop goes above the 50, and you cover into those big 120-200 supports, or if the fast momentum flips back against you.
And the most important rule for discipline, no trade.
When the ribbon is braided, flat, crossing constantly, when that braid filter is on, you do nothing, you wait. The risk-reward is just terrible. The system gives you permission to just step away and preserve your capital.
Now, a huge part of the source is the research and backtesting mandate. The order you test in is essential to avoid curve fitting.
Curve fitting is the silent killer of trading strategies. You can't just tweak your parameters until the backtest looks pretty. The testing has to be sequential to prove the logic is sound. Step 1 is you have to prove your regime definitions. The 120 versus 200 plus the slope are robust across many years.
Then step 2 is testing the continuation entries in isolation.
Exactly. Does the core entry idea actually have an edge? If your entry doesn't work, no exit strategy in the world can save it. Then step 3 is you add and compare the different exits. You test the 20-day trailing stop versus the 50-day. You see the trade-offs. Only then, step 4, do you measure your metrics. Win rate, average win-loss, max drawdown, all that stuff.
And the final step is the stress test.
You have to stress test it by market type. A strong bull year like 2021, a clear bear year like 2022, and most importantly, a choppy sideways year. A robust strategy doesn't have to make money in the sideways year, but it must minimize the losses. If it can survive the chop, it's a viable system.
Okay, let's get into the nitty-gritty. The code parameters, or the tuning knobs. These are the variables in the code that let you adapt the system.
Yeah, and you need to understand the trade-offs. First is stop tact, let's say 1.5%. This sets your stop tightness. If you trade a slow-moving utility stock, maybe a tight 1% stop is fine. But if you're trading a volatile tech stock or crypto, you might need 2.5% just to avoid getting stopped out by normal daily noise.
So it's noise reduction versus how much capital you're exposing.
Exactly. Then there's zone PUT, say 0.5%. This defines how close the price has to get to the SMA 50 to count as a valid pullback for an entry.
So if you loosen that, you get more trades.
Right. If you raise it to 1%, you'll allow pullbacks that just get close to the 50. More trades, but maybe lower quality. If you keep it tight, you get fewer trades, but you know you're entering at the optimal structural point. It's a volume versus quality trade-off.
And the most crucial knob for discipline, the braid thresh, which was 0.5%.
This is your absolute market filter. If your backtest shows you're getting killed in sideways markets, you need to raise this value, maybe to 0.7% or even 1.0%. By doing that, you're forcing the 20 and 50 MAs to be more clearly trending before the system will even let you place a trade. It drastically cuts down on false signals in messy markets.
And finally, there's this optional profit logic, like taking profit if price gets 6% away from the SMA 20.
This is just a risk mitigation tool. If a stock moves 6% away from its 20-day moving average, it's statistically overbought in the very short term. A long-term trend might be fine, but a snapback to that 20 MA is highly probable. So this logic can trigger either taking some partial profits off the table or just tightening your stop super aggressively to lock in gains.
Right. And the source wraps this section up by showing how the logic can be translated to any platform, TradingView, Thinkorswim, whatever.
The point is that the rules are rigid logic statements. It doesn't matter what platform you use. As long as you can define an SMA and use crossover logic, you can build and test the system. Its testability is probably its greatest asset.
So to bring this all back down to a practical example, let's revisit that summary analysis of the SAVI chart that was in the source material. We can apply the playbook's rules to how they saw that setup.
Okay, yeah. So in that SoFi example, the current price, which was around 25.27, was described as battling the 120 MA, a key intermediate level. And crucially, the fast MAs, the 5, 10, and 20, were all positioned above the price.
Which confirms short-term selling pressure.
Exactly. So tactically, the immediate pressure was down. But, and this is the important part, you have to look at the bigger picture.
The regime context.
The regime context was key. The long MAs, you see the 200, 270, 360, 500, they were all positioned well below the price. This confirmed a really robust, larger up structure. The gravity was still bullish.
So the playbook would categorize the current weakness not as a new bear trend, but as a high probability pullback within a larger uptrend.
Exactly, a pullback or a transition. So the playbook's rule was patience. You had to wait for one of two specific signals.
Okay, what were they?
Scenario one was a bullish recovery. That would require the price to reclaim the 20 MA. Then you'd need to see the 5, 10, and 20 stack back up properly, and then it had to hold above the 50 MA. That would validate the continuation entry.
And the other scenario?
A bear continuation. This would be if price failed under the 20 and 50, and you saw the 20 start to roll over and head for a bearish cross below the 50. The point is, the playbook dictates you wait for a mechanical signal. You don't guess.
What really stands out to me about this whole TKIF playbook and why I think it's so valuable for you, the learner, is its total commitment to structural clarity. It gives you a system for defining market states, not just for finding signals, and that seems like the absolute prerequisite for any kind of consistent success.
I agree. The system forces discipline. It gives you 10 specific data points to confirm your bias before you even think about risking capital. It minimizes that reliance on gut feelings, and it maximizes the influence of quantified structure and momentum. It's a filter engine. It's designed to keep you out of bad trades just as much as it's designed to put you into good ones.
This brings us to our final provocative thought, and it's about the very structure of the playbook itself. It places this incredible weight on those deepest averages, the 270, 350, and 500-day. These averages are capturing market memory across 1 to 2 full years.
And they are the primary drivers of the regime definition, which in turn governs the short-term tactical entries like that 5-10 cross. So this raises a pretty fundamental question for you to explore on your own.
Which is?
If institutional systems put this much weight on the deepest end of the ribbon, on the 2-year average, is any of the short-term timing we talked about really short-term?
Interesting.
The system suggests that the long-term gravity always dictates the probability of any short-term move. So are we ever really just trading today's momentum? Or is all of our tactical timing simply a delayed, almost inevitable reaction to multi-year cycles that are captured by the deep memory embedded in that 500-day moving average?
That long-term structure always precedes short-term action.
That's the framework. And it's something to really mull over as you start trying to apply this kind of structured view to the market.
A really profound way to end this deep dive into the TKIF playbook. Thank you for walking us through this tactical blueprint. We'll be back next time on Beyond the Comfort Zone Talking Shit with KING-KAMBUF.